Right now, in one of California's most desirable mountain towns, there is this massive 15-month supply of million-dollar condos just sitting completely unsold.
Yeah, and if you follow conventional real estate logic, I mean, a 15-month backlog of inventory should trigger an absolute panic.
Exactly. Prices should be in free fall, right? Sellers should be getting desperate. But in this specific market, prices are largely holding steady, and the sellers, well, they just aren't blinking.
Which is wild.
Yeah.
And today we're going to figure out exactly why. Welcome to the Deep Dive. I'm your resident real estate data expert.
And I'm your host. Our mission for this deep dive is to unpack a very specific set of data, the Mammoth Lakes real estate market update for March 2026.
Right, so we've finally closed the books on 2025, and we have the first 2 full months of 2026 in hand.
Yeah, and we want to show you, the listener, exactly what it looks like when a high-demand destination market shifts away from that wild pandemic-era speculation.
You know, it settles into this really sustainable rhythm driven by lifestyle and long-term value. The data points all scream three words right now: balanced, selective, and resilient.
But if you're listening and wondering, why should I care about a real estate snapshot from a mountain town if I have zero intention of buying a ski cabin?
Well, you have to look at it as a laboratory. Mammoth Lakes right now is acting as this perfect microcosm of a maturing real estate economy.
Right. It illustrates what happens when extreme leverage gets completely flushed out of the system.
Exactly. It shows us how buyers behave when, after years of absolute frenzy, they finally get the power of time back on their side.
So let's start by translating that big conceptual theme into the hard inventory data. Because when you hear market balance, you might assume it means this perfect, static equilibrium.
Right, like nothing ever changes.
Yeah, but looking at the 2025 data, balance actually looks like a very healthy seasonal wave. Through the summer months of last year, active condo listings rose, peaking at over 115.
Which is totally normal.
Right. And then as the market eased toward year end, that number organically dropped down to around 90.
And that seasonal ebb and flow is just the heartbeat of a normal destination market. You expect inventory to swell before the major peak seasons and then contract afterward.
So fast forward to our current snapshot, which is as of March 1st, 2026. There are 89 condos and 19 single-family homes listed for sale.
Overall inventory is undeniably higher than it was in 2024, but, and this is key, it is sitting squarely within the 10-year historical norms.
Yeah, overall supply is hovering at a very healthy 4 to 5 months.
And the underlying psychology behind that 4 to 5 month supply is just fascinating. We're coming off this prolonged period of rapid, almost aggressive appreciation.
Right, the boom years.
Exactly. And now that appreciation is flattening out.
Right.
In a highly leveraged speculative market, flat prices are terrifying.
Oh, for sure, because investors are relying on constant growth to outpace their debt.
Right. But in a maturing market like Mammoth Lakes, flattening is actually a sign of structural health.
Well, and you're attributing that structural health to the sellers because, if I'm a seller who bought 3 years ago on an adjustable rate mortgage, or I stretched my debt-to-income ratio to the absolute limit hoping to flip a property.
A flattening market is your worst nightmare?
Exactly. I'd have to sell before my carrying costs sink me.
But those aren't the sellers supporting the Mammoth market right now. The current baseline is maintained by sellers with long-term ownership horizons and incredibly low leverage.
Right. They either own these properties outright or they're sitting on those locked-in historically low interest rates.
Yeah, they simply aren't desperate to offload their assets. The inventory rises to that normal 4 or 5 month supply, but the floor just doesn't drop out on pricing because the sellers can afford to wait.
They view the property as a hard asset, not just a quick flip.
Exactly.
But if sellers are perfectly comfortable waiting, we really have to look at the other side of the equation. Because inventory is up compared to 2024, and properties are sitting on the market much longer. Shouldn't buyers be walking in and demanding massive discounts? It feels like a high-stakes game of musical chairs, where the music finally stopped. There are actually enough chairs for everyone in the room, but the buyers are just standing around analyzing the upholstery instead of sitting down.
That is a great analogy. And because buyers finally have the luxury of time, they are realizing some of those shares have hidden trapdoors.
Ah, okay.
They are highly selective now. That explains the stark divide in what actually sells. A well-prepared, realistically priced property, a sturdy chair with good upholstery that still moves and commands a strong result.
But the dated units.
Yeah, or the ones where a seller is still clinging to that pandemic-era aspirational pricing, buyers are simply walking past them.
Wow.
Those properties are requiring severe price adjustments or punishingly long marketing periods just to secure a showing.
So buyers are perfectly willing to sit down. They just refuse to pay peak market prices for a chair with a wobbly leg or deferred maintenance. The desperation is totally gone.
They are acting with intention. When urgency leaves a market, deep due diligence replaces it.
Which brings us to a massive distortion in the data. Because buyers are being so deliberate, we have to break down exactly what they're choosing to buy.
Right, you can't just look at the overall numbers.
No, because there's a staggering contrast right now between the high-volume condo market and the ultra-low-volume single-family home market.
You really cannot treat those two segments as the same economy.
So let's pull the condo data first, since condos are basically the engine of the Mammoth housing market. In the first 2 months of 2026, total condo sales have dropped to just 13 per month.
Which is quite a dip.
Yeah, for context, in 2025, that average was 22 per month, and the pricing absolutely reflects that deceleration. The median sale price for a condo so far in 2026 has settled at $699,000.
Down from $825,000 in 2025.
Exactly, and the median price per square foot also contracted, dropping from $675 down to $606.
And the days on market metrics tell the exact same story. Active listings are sitting for an average of 52 days, and closed listings took about 79 days from list to close.
So the condo market is visibly cooling, lengthening out, and adjusting its pricing downward.
Yeah.
But then you flip the page to the single-family homes, and the numbers look completely detached from reality.
They really do.
There are only about 3 single-family home sales per month in early 2026. Yet the median sale price skyrocketed to $2,840,000.
It's a huge number.
The massive jump from the $1.3 million we saw in 2025. The price per square foot jumped from $637 to $756 jump. And the homes moving the fastest in that segment feature garage space, good natural light, and ADU potential.
Now, if you are looking at that median price jump and thinking, wow, the value of a house in Mammoth just doubled overnight, you really have to look closer at the math.
Yeah, don't fall for it.
It is one of the most common statistical traps in real estate data.
It's the ultimate small sample size problem, right?
Yeah. It's a total optical illusion. When you only have 2 full months of data and the market is only moving 3 units a month, your entire trend line is based on 6 transactions.
Right.
If just 2 of those 6 sales happen to be spectacular, ultra-luxury properties closing in January or February, they drag the entire median price upward for the whole segment.
It does not mean the intrinsic value of a standard single-family home doubled.
Not at all.
I mean, it is literally like flipping a coin twice, getting heads both times, and confidently telling people this specific coin will never land on tails.
Exactly.
You simply cannot establish a macroeconomic trend on 6 isolated data points.
You can't. The single-family inventory has remained incredibly tight, averaging around 20 active listings last year and sitting at 19 right now. It's a stable market, particularly for homes that offer income-offsetting features like ADU potential.
Right, but that $2.84 million median is purely a reflection of what specific tier of homes happen to sell in those 8 weeks.
Exactly. It is not a market-wide explosion.
So, if the single-family home data is a statistical mirage, let's pivot to a very real, very tangible friction point. Let's talk about the carrying costs.
Oh boy, yeah.
Because there's an absolute elephant in the room when it comes to mountain living. And it perfectly explains that 79-day closing timeline for condos.
The hidden costs of ownership are dictating buyer behavior far more than the sticker price right now.
So let's lay the groundwork with interest rates. As of March 20, 2026, the prevailing conforming rate for a 30-year fixed mortgage is 6.53%.
Right.
And for a jumbo mortgage, it's 6.63%. Now, in a market where the single-family median is occasionally pushing nearly $3 million, almost everyone who finances is being forced into a jumbo loan.
Because they far exceed the standard conforming limits.
Exactly. Now, these mid-6% rates are actually a significant relief compared to the violent rate hike cycles of the past few years.
Oh, absolutely.
They stabilized late in 2025, ticked up a hair in early March, but largely they have restored a baseline of predictability.
And predictability is the key word there. A buyer looking at a 6.63% jumbo rate might not love the number, but they can finally build a reliable spreadsheet.
They know exactly what their monthly principal and interest payment will be.
Yeah, the fear of waking up to a radically different mortgage landscape every single week has finally dissipated.
But the spreadsheet is still breaking down, and here's why. When you dig into the micromarkets within this data, a glaring anomaly jumps off the page.
Yep.
We established earlier that the overall Mammoth market has a very healthy 4 to 5 month supply of inventory. But if you isolate condos priced between $1 million and $1.5 million, you suddenly hit a massive 15-month supply.
It's a huge spike.
Meanwhile, single-family homes in that exact same $1 million to $1.5 million price range only have a 6-month supply.
And a 15-month supply is a deeply entrenched buyer's market. That means properties are piling up with very few takers.
Well, and if I am a buyer staring at that 15-month supply of million-dollar condos,
Yeah.
my instinct is to aggressively lowball. I have all the leverage. But given the broader context, a lower purchase price probably doesn't mean I'm actually saving money month to month. Am I just walking blindly into a trap of secondary costs?
That is the exact mechanism freezing that segment of the market right now. You mentioned the predictability of the mid 6% mortgage rates giving buyers a reliable spreadsheet.
Yeah.
Well, that predictability is being completely obliterated by the extreme volatility of mountain property insurance.
Explain the mechanics of that, because I think a lot of people assume insurance is just a standard fixed line item you check off at closing.
Right. And in a standard suburban market, maybe it is, but in a mountain resort town, insurance is a highly volatile variable.
Okay.
Condo complexes operate on master insurance policies. Over the last few years, due to statewide wildfire risks and extreme weather modeling, many major primary insurance carriers have simply retreated from these regions.
They just drop the master policies entirely.
Exactly. And then the homeowners association is forced to secure coverage on the secondary or surplus lines market.
Where I imagine it's not cheap.
Not at all. Premiums can easily triple or quadruple overnight.
And the HOA doesn't magically absorb that cost. They have
No.
to pass it directly down to the individual condo owners.
Right. By heavily increasing the monthly HOA dues, or worse, imposing a massive special assessment.
Ouch.
Yeah, a special assessment is essentially a sudden, mandatory bill, sometimes tens of thousands of dollars handed to each owner to cover the insurance gap or fund deferred maintenance.
So this completely recontextualizes the data. When we look at that 15-month supply of high-end condos sitting stagnant, and we see closed listings taking 79 days to cross the finish line.
It isn't just buyers dragging their feet or haggling over the price of the furniture.
Right. Buyers are executing forensic-level due diligence.
Exactly. They aren't just negotiating the listing price, they are interrogating the financial health of the HOA. They are pulling reserve studies, checking the master policy renewal dates, and looking for looming special assessments.
Because if a buyer secures a condo for $50,000 under asking, but gets hit with a $30,000 special assessment and doubled HOA dues 6 months later.
Their debt-to-income ratio is totally destroyed. The delay in closing is simply buyers protecting themselves from catastrophic hidden carrying costs.
Wow. Okay, so we've mapped out the normalizing inventory, we've dismantled the statistical illusion of the single-family median price, and we've exposed the insurance mechanisms tying up the condo market.
We covered a lot of ground.
We really did.
Yeah.
So pulling all of this macro data and friction together, what is the actual playbook for the rest of 2026? If you are navigating this economy, what's the strategy?
The dominant strategy for 2026 is entirely dependent on meticulous preparation and realistic pricing.
Okay.
The era of speculative timing, hoping to catch a sudden macroeconomic wave to bail out a bad real estate decision is completely off.
So the leverage clearly sits with the buyers right now, especially if they're willing to put in the analytical work.
Buyers have the power of options. If you are looking at stale listings properties that have languished on the market for 90 or 120 days because they were overpriced out of the gate or burdened with deferred maintenance,
You have immense negotiating power.
you really do. But you have to use that time to underrate the secondary costs, verify the insurance, verify the HOA reserves.
And for sellers, the reality check seems a bit harsher, but it isn't impossible, right? It just requires abandoning that 2022 mindset.
Sellers who present highly updated, well-maintained properties are still seeing strong results, particularly if they have features that offset costs, like ADU potential or premium locations.
Right.
But if a seller insists on aspirational pricing, just throwing a massive number on the listing to see if a desperate buyer bites the market will ignore them, success requires rapid, data-driven price adjustments to meet the buyers where they actually are.
What about the macroeconomic forces? Will a shift in interest rates disrupt this balanced rhythm later in the year?
Well, the expectation is a modest easing of interest rates as 2026 progresses, but it is crucial to temper expectations around what that actually does to the market.
It's not a magic wand.
No, small declines in the mortgage rate will incrementally improve affordability and keep buyer confidence stable. It will support steady, reliable demand, but it will not trigger a return to the bidding war frenzy.
Bringing this all back to the core theme we set out to explore in this deep dive, the Wild West era of real estate has officially closed its doors.
It really has.
You can no longer stick a for sale sign in a snowbank and expect a blind bidding war with waived inspections. The market is matured, it is thoughtful, it is methodical, and it relentlessly rewards realistic expectations and deep due diligence.
Mammoth Lakes is establishing a deliberate, sustainable rhythm that will likely carry through the rest of the year.
Yeah.
The condo segment will continue to do the heavy lifting in terms of volume, particularly in the mid-price ranges where buyers can justify the carrying costs.
And meanwhile, the single-family segment will remain rock solid, anchored by historically low inventory.
Exactly. Even at the very top of the market, the data reinforces this theme. Luxury single-family homes, properties priced above $2.5 million, are currently sitting at a balanced 4-month supply.
So from the entry-level condo to the luxury estate,
Mhm.
equilibrium really is the defining metric. We've taken a mechanical look at what it actually means when a housing market takes a breath, stabilizes, and matures into something sustainable.
It's been a fascinating shift to watch.
Thank you for joining us on this deep dive as we explored the reality behind the headlines and decoded the stabilizing mechanics of destination real estate.
And, thinking back to our opening premise about a market moving away from wild short-term speculation, it introduces a fascinating sociological question to consider.
Oh, definitely.
If a beautiful destination town like Mammoth Lakes is permanently shifting away from rapid flipping and settling into an era of long-term lifestyle-driven ownership,
Yeah.
what does that do to the soul of the town itself?
That's a great point.
When the chaotic urgency and the quick cash speculation finally leave the system, does a transient resort town organically become a more stable, closely knit community? It is something to think about the next time you see a for sale sign.